Okay guys, I'm going to show you another HD discussion which is obviously related to our previous videos. We have gone through the net present value, we have gone through the calculations of capital allowances and written down value of an asset, and also we have worked down the concept of present values and with the help of the cost of capital as well, with the numerical problems. But right now we're going to discuss, we have talked about the cost of capital and the rate of it when calculating the NPV, net present value. Let us see how we're going to discuss about the whole concept of the cost of capital, and it is how it is being related to the relative cost of equity and debt, and obviously we can actually show it with the help of some of the notes as well that we have provided for you guys, so that you can see that what is the cost of capital, how it is related to the cost of equity and debt. It is a very short discussion, by the way, and you can have, if you are interested, we will obviously get into the more details, but just for the sake of the examination point of view or for the sake of general understanding, you can have this video in front of you. So relative cost of equity and debt. Cost of finance is normally dependent on two main factors: prevailing risk-free rate, which is RF, rate of return, which is the minimum rate required by all investments. That is the minimum rate required by all investment. Normally in examination it is known as the treasury investments, or known as the gilt items. So that is how it's been, and the rate would be mentioned in the examination as well if you're talking about from the examination perspective. So it is the minimum required rate by all investments, and it is the risk-free rate of return. The second is the reward investors demand for the risk they take in advancing funds to firm. This is the reward normally, and because the cost of finance is dependent upon the reward investors demand for the risk they take in advancing funds to the firm. Obviously, normally the investors fund in the funds in companies or the firm, so obviously in regard that they want a reward as well. So that is how you can say that is the cost of the finance. Okay, and a cost of the capital that obviously invested. Identify the sources of finance needed. First of all, it is the debt financing if you're going to finance it through loans, or it is through the equity financing if you're going to finance it through the shares. And debt financing, identify type of debt. Okay, first of all, you need to identify the type of debt. We can go in detail about the types of debt in some of our next video. And then afterwards, you're going to calculate the cost of each debt. And here it is from the equity finance cost, calculate cost of equity, and combining all costs, we're going to find the weighted average cost of capital, which is also another piece of discussion or piece of explanation with the help of some problem in some other videos we'll try to discuss, just to give you an idea what is the flow of the equity financing and the debt financing. And right now we are just going to talk about the cost of equity, okay, and the cost of debt. That will help us to find out this weighted average cost of capital, which will be calculated in some other video. Relationship risk and return, which is the trade-off. Actual returns varies from the forecast, and because of the risk, returns varies from the forecast. It means that if there's a risk, that doesn't mean that it is a pure loss, but obviously actual returns varies from the forecast. We have a pictorial representation that is in front of us, and it is 4 points: A, B, C, and D. B is preferable to A. Okay, return is high, but risk is same. You can see this is the relationship between risk and return. Okay, so return is obviously high as compared to A, but risk falls at the same position. But B is preferable to A because of the higher return. C is preferable to B. C is preferable to B because return is same, but the risk is very low. You can see that the risk is very low as compared to B, so C is preferable to B. There is a trade-off of risk and return that I have shown just with the help of a simple pictorial representation. Now we're going to discuss, The return on risky investments, which are the loan notes, because we have talked about the debt financing, so that normally because under the cover of loan notes, so risk-free investment has a certain return. Although not risk-free, loan notes are low-risk investments than equities. Obviously, they are more secure as well as compared to equity financing. That is why it has the low risk element. Okay, because we can predict the return as well. In what ways? Because interest is a legal commitment. You have to pay the interest whatsoever the case. Interest will be paid before any dividends. Okay, that is interest needs to be paid, it has to be paid, and it would be paid. And loans are often secured, that I've discussed. Normally in the case of the assets of a company, the loans are taken against the assets, so that means it are fairly secured. If a company issues loan notes, the returns needed to attract investments will therefore be higher than RF, which is a risk-free rate of return. Okay, the minimum rate of investment that is obviously higher than RF, lower than rate on equities. Okay, that means the returns on the loan notes will be higher than what this RF, but below than equities. Obviously, we know that equities are less secure because of the unpredictable nature of return. And we can also have some system which is bond rating system. Okay, Fitch and Standard Poor's bond rating scales. Okay, this is in front of you. Fitch, S&P grade, and also the risk. When you're talking about the grading, AAA means it is an investment in the grade of investment, and risk is highest quality. Okay. The risk is of obviously highest quality, and obviously the return would also be the highest. But it is the AAA, investment into highest quality. AA would be investment high quality, and return you can also have that as Y in front of you. And also A is also investment strong. BBB is also in the grade of investment, which is medium grade. Okay, and also BB with B is junk, and it is speculative. With the CC or C, all three falls in the category of junk, and it is highly speculative. D falls obviously in the grade of junk, and it also in default. So these are the grading system, these are the risk and return categorization against the grading, and also there is the rating which will be normally prescribed by the Fitch, Standard & Poor's bond rating scales. Okay, this is how you're going to say it. Return on risky investments. Equity, obviously I have discussed the equities are more risky as compared to the loan notes because of the unpredictable nature of return. Equity shareholders are paid only after all the commitments have been paid, that's for sure. So last investment to be paid out of company's profit. So equity holders are the last investment to be paid out of the company's profit. When the loan is being paid, the taxes are being paid, the interest has been paid, the dividend has been paid, the equity shareholders share would come at the end, and that would be in the form of, obviously normally it is in the form of the dividend. So you can say that these are at the end when all has been paid. So what we're going to say, what will the order of priority when in case of company? First of all are the secured lenders. Okay, and normally these are the banks and legally protected creditors such as tax authority. You have to pay the tax as well. Then afterwards it is unsecured creditors. Okay, and also that is preference shareholders and ordinary shareholders that come at the end. So this is how you can say that is the order of priority of payment when you come to have the profits of the company and going to pay the profits. You're going to have this order in mind. This will be secured lender, bank, legally protected creditors such as tax authorities. It has to be deducted on the behalf of the government, and unsecured creditors, preference shareholders, ordinary shareholders. And normally in the case of when you are actually in the case of buyers, going to deduct on the behalf of buyers for the government, and that is normally at that level. But we have different cases to be discussed. We can discuss. We have a lot of time to discuss. That's not a question. So this is the equity shareholders, and now what I'm going to do, obviously we have discussed about the equity and the equity financing. We're going to discuss about how we're going to calculate the cost of equity, or DVM, or the cost of equity, DVM with growth and without any growth. So these are the two questions I'm going to apply right now with the help of this small discussion. It is a very large discussion, by the way. When you're talking about in details, the various concepts need to be taken into account, but I just want to actually share the critical nature of examination, and also just for the fundamental concepts of this. That is why I've just taken it in short, so that the students in general and specifically as well will take an interest in videos, and they can share it, and also they can have the applications as well. So for the DVM, cost of capital, estimating what you can say the cost of equity, first of all, with no growth, we have to discuss it with no growth. And a company has paid a dividend of 20 cents for many years. The company expects to continue paying dividends at this level in the future. The company's cost of equity is 10%. Requirement is calculate the market value of share. This is the requirement. So this is the formula. P naught is equal to dividend divided by return on equity. So just putting out the values, that would be 20 divided by 1.010%. That would be $200. Okay, that would be the P naught. And when we're going to DVD, that is DVM with no growth, or the cost of equity with no growth. That is now the cost of equity with growth. That is the formula. P naught D is equal to what? Into 1 plus G into RE minus G. The company has just paid a dividend of 20C. The company expect dividends to grow at 7% in the future. The company's current cost of equity is 12%. Calculate the market value of share. What would be the market value of share? This is the question that we need to actually, because we have the formula in front of you, just putting out the values, we'll be able to actually get the result as well. So P naught, because the dividend would be at 20, and 1 plus G would be the growth, 1 plus 0.07, and then afterwards it would be 1.2, and that would be minus, that is the cost of equity. By the way, cost of equity is 0.12, and the dividends to grow at 0.07, and that would be 428, and that would be $428. Okay, so this is now the P naught. When we're talking about the growth factor, which was 7%, we have taken that into account in this formula, and we have actually reached out the P naught, which is the market value of the share when we're talking about with growth. Okay, so this is a small bit of the exercise, the discussion. I hope that you're going to actually take some information, and if you're not, please do mention it in the comment section. Anytime you're going to watch this video, we're going to be waiting for your comments, likes, and subscription, and any other discussion in the relative topic. So hope to see you with some another interesting video. Till then, take care and have a nice day.